Good morning, everybody. My name is Joan Larea. I'm the CEO of Convergence, and I'm delighted to be with all of you today at the release of our 8th edition of the State of Blended Finance. Our earlier State of the Industry reports tended to focus on factual mapping of the field, really putting out the data that enabled people using blended finance to get their work done. And as we've progressed to guiding the field toward what we think of as good practice, standardization, scale, more organized and effective use of catalytic funding, we've recognized that blended finance operates in a broader context of finance and development finance. So we are continuing to innovate. And in this edition, you'll notice that we've introduced some new elements, including a look at the world of regulation, standard setting, credit ratings, and sovereign risk. We also are back to doing a full field review in this edition of the State of Blended Finance, looking at all the sectors that we see showing up in the field. And later this year, we'll come out with another climate edition of this report. So from here forward, you can expect us to do a full with the field report, as well as a report that focuses on climate and mitigation blended finance. So this morning, I'm going to be asking the team to present the core findings of the State of Blended Finance and allow some Q&A from the audience. So be prepared, put your questions in the Q&A field. And after that, we'll have a panel of some voices coming from that context of the broader financial world that I just mentioned. And again, you'll have an opportunity to ask our panelists some Q&A as well. So allow me to pass the baton on to the team.
Thanks so much, Joan. We can move on to the next slide. Perfect. So as Joan mentioned, this edition of the report and the first of this new two-report annual cycle will address the entire blended finance market, whereas the one that we just released this past fall was a climate-focused edition. And again, we'll cover, along with our own data from our historical deals database, look at some of the regulatory regimes that encompass and interact with the blended finance market, excuse me, as well as some examinations and insights on transparency and mobilization reporting and targeting in the blended finance market as well. So we can move on to the next slide. Perfect. So I'll actually be taking us briefly through some of the highlight market trends that we've observed across blended finance over the past year. Next slide, please. So to date, Convergence's historical deals database includes over 1,120 blended transactions worth a total of $213 billion. So as we know, the macroeconomic environment continued to be challenging for most emerging markets and developing economies in 2023, underscored by geopolitical instability and mounting sovereign and corporate debt levels. During this turbulence, however, the blended finance market proved resilient. Following a 10-year low in financing to blended finance deals in 2022, Convergence found that the market rebounded strongly in 2023, reaching near pre-pandemic levels of investment flows. Financing totals actually grew by over 70% last year. More rapid disinflation in developing economies than initially expected, lower currency volatility, and rebounding private credit and debt activity all contributed to that bounce back. After years of ups and downs in activity over the last decade, Convergence recorded a greater frequency of large transactions coming to market than any year since the pandemic. 40% of blended deals launched in 2023 were greater than $100 million. So as was profiled in our last annual report in the fall, climate blended finance deals form a strong theme within the blended finance market as a whole, and these deals are reaching scale more consistently than other market segments. Overall, climate blended finance accounts for about half of total deal count and just under 60% of total financing. So if we zoom in on the last 3 years, we see climate become an even stronger focus, with about 3/4 of investment to blended finance destined for climate deals. Climate financing flows have also been a key driver of last year's market growth, with flows increasing over 100% in the last year. About half of climate blended finance deals last year were $100 million or larger, again showing evidence of the real appetite from investors for scaled vehicles in this sector. Next slide, please. So here we have the different sources of financing to blended finance recorded by Convergence between 2018 and 2023. And again, I just want to point out that these sources of financing totals are different than what we find when we look at total deal size, just based on our ability to record and capture investment amounts from the market, given disclosure, confidentiality, and transparency considerations. So I want to direct everyone's attention to the ODA portions of each bar, which are the sections here that I've highlighted in red. So ODA volumes to blended finance gradually declined in recent years, with the value dropping 45% in 2023 from what was registered in 2021. So the decline is in part a consequence of the redirection of ODA in response to the invasion of Ukraine by Russia. And according to the OECD, 90% of those funds were dispersed to the public sector. By comparison, 10% of ODA provided to the blended finance market in 2022 was allocated to projects in Ukraine, and just 1% last year. So with scarce ODA supply, DFIs and MDBs stepped up in 2023 and played a central role in last year's market rebound. So after falling to a 6-year low in investment in 2022, DFIs and MDBs committed almost 150% more to blended finance deals last year. Convergence finds that the presence of DFIs and MDBs reduces the amount of ODA necessary to draw in private sector investors and close blended deals. In other words, DFI and MDB participation stretches those ODA totals or investment dollars further. So we have found that the leverage ratio, which is the amount of commercial capital for every $1 of concessional capital in a transaction, is larger in deals that are $100 million or larger when there's market rate participation from a DFI or MDB. So every dollar of concessional capital mobilizes just over $5 of commercial capital when there is a DFI or MDB present, versus just $2.50 when there isn't. However, given the limited asset bases of DFIs and MDBs, ODA supply to blended finance must grow to bridge those financing gaps in emerging markets. Next slide, please. So as Joan mentioned, this year we break down the blended finance market by sector, providing deal trends, excuse me, and investor data across agriculture, energy, financial services, health and education, and infrastructure. Next slide. So here we summarize some of those findings into a handful of key takeaways. So we encourage you to dive into the report for more detailed insights and findings on the sector or sectors that are of interest to you. So within agriculture, we found that deals are relatively smaller than what we see in the overall market, and they typically channel capital and impact to smallholder farmers via large and mid-sized companies. The energy sector remains the most active segment of the blended finance market, accounting for 1/3 of all deals and nearly half of total investment. Blended finance in the financial services sector is increasingly focused on expanding and protecting the lending capacity of commercial banks to emerging market small enterprises. Health and education continues to comprise the smallest portion of the overall market, but an outsized use of impact bond use, and still remains reliant on grant capital from donors. And finally, the infrastructure sector has undergone a notable shift whereby blended deals are increasingly supporting the working capital needs of project sponsors in place of pure project finance. So I'll now pass it over to my colleague, Andrew Pompa, who will discuss the regulatory context of blended finance. Over to you, Andrew.
Thank you very much, Nick. For the first time this year, Convergence examines the regulatory context of blended finance. Next slide, please. The sovereign risk ratings of most developing countries are beyond the mandate and criteria of many investors, and regulators require key financial institutions to hold more capital in reserve for riskier assets. The ability of private investors to participate in blended finance as a stepping stone to investing in emerging market transactions with acceptable risk-return ratios is thus affected by key regulatory factors. In this section of the report, we review some of the key regulations affecting whether and how private sector investors can participate in blended finance, including the Basel Accords, current international accounting standards, EU legislation on securitization and state aid, and issues surrounding the domiciliation of investment vehicles. Next slide, please. In the report, we also explore the evolving perspective of financial supervisors and regulators on blended finance, and Convergence's view on how the blended finance community can address the regulatory challenges identified. We present three major recommendations within the report. First of all, we should adopt a multi-stakeholder approach to building understanding on blended finance. We can do this, first of all, by removing silos between the blended finance and supervisory communities. Financial supervisors and regulators are becoming more aware of blended finance, yet they're often not represented in or consulted by many organizations within the blended finance ecosystem. This means that the perspective of those responsible for maintaining financial stability is often excluded from broader conversations on maximizing mobilization for development. Supervisors need to be consulted early in blended transactions, become more educated on the practice and scope of blended finance through indicative case studies of what worked and didn't work, and ultimately coordinate with each other where necessary to address common barriers and obstacles while protecting the integrity of the financial system. We should also create a formal framework, providing policymakers and regulators with a starting point in how to approach blended finance. A multi-stakeholder approach must also involve the creation of a formal framework as a starting point for policymakers and regulators to approach blended finance. So this framework should build on the G20 blended finance principles and provide guidance on how to implement an enabling environment for blended finance. In addition, the creation of multi-stakeholder platforms in different national contexts that encourage dialogue and the sharing of learnings between the public, private, and regulatory communities must be encouraged. The sustainable finance work streams within such platforms should have a dedicated dialogue on blended finance to encourage momentum on bringing diverse stakeholders together in areas where the need for more blended activity has been recognized. The second recommendation that we have is that practitioners should use supranational forums as the space for donors and supervisors to dialogue on capital allocation rules. Supranational forums should facilitate peer-to-peer learning amongst countries on the experience and practice of blended finance, which should be instituted as a key pillar within broader working groups centered on sustainable finance. Any learnings from these forums can in turn feed through to standard-setting bodies. Regulatory harmonization to better catalyze financing for the global climate crisis or for developing markets, for example, could be an initiative taken up at the level of the G7 or the G20. Ultimately, consultations addressing regulatory hurdles to scaling financing to developing economies must take place at the supranational level amongst policymakers. Going forward, ensuring that development stakeholders have a seat at the table when regulations are being designed and implemented will be critical. And of course, as part of this process, having de-risked primarily DFIs and MDBs historically, donors must build their awareness of the regulatory hurdles faced by large-scale institutional investors and work with them to better calibrate concessional tools to existing regulatory structures. Finally, practitioners should prioritize data transparency to showcase the actual risk of investing in developing markets to regulators and institutional investors. One effect of insufficient data transparency in the blended finance and development finance ecosystems is that regulators are missing information on the actual risks of investing in developing markets. There's a significant lack of understanding of expected losses and probability of default for large swathes of emerging market assets in general, leading to the inherent conservatism of regulators and standard setters. Another way that DFIs and MDBs could support the mobilization of private investors is by sharing more extensively the payment track records of their portfolios. Such data is consolidated in the GEMS database, for example, and its release would illustrate that well-structured project finance in developing economies is not as bad as thought. A first step was taken, of course, in March 2024 with the publication of a GEMS report showcasing aggregate data on the recovery rates of investments with private and sub-sovereign borrowers in emerging markets. With access to an adequate data set, rating agencies could be more actively involved in rating blended funds and instruments to better reflect the credit enhancement benefits from first loss and junior tranche layers. And with that, I'll hand over to my colleague Aisha to take us through the next part of the presentation.
Thank you, Andrew. Hi, everyone. So in my section, I'll be walking us through the second thematic topic that we focus in this year's report. So in our second thematic discussion in this year's State of Blended Finance, building off of Andrew's last point, we really reflect on the state of data transparency in the blended finance market and what comparing different data sets really tells us about the effectiveness and impact of blended finance. So if we move to the next slide, what we've done in this report is we've compared data trends from 3 of the largest data collectors in the market. So this would be the DFI Working Group on Blended Concessional Finance, the OECD, and Convergence. So we do recognize that there is some confusion in the market regarding what each blended finance actor is measuring and defining. So in the report, what we firstly map out how these bodies are reporting on different aspects of the blended finance market. So within the report, we've created a matrix that compares the definitions of blended finance, what the reports are on private sector mobilization trends, what the estimates are for the size of the blended finance market based on the last comparable time period, and who the key constituencies reporting into these different market estimates are. So really the goal here is to try to understand holistically what is the map of the blended finance market and what does it tell us about where we are in achieving scale. So if we move to the next slide, we'll cover some of the high-level findings. So firstly, our findings reveal that the OECD does report the largest estimate of blended finance flows. And this is because the OECD does have the most inclusive definition of blended finance. So the OECD does measure both upstream concessional capital facilities as well as downstream private sector mobilization. In contrast to that, Convergence and the DFI Working Group are looking more at blended finance transactions that include both concessional and private capital. So looking at a different segment of the market. So because Convergence and the DFI Working Group do have more similar definitions, we also provide a more in-depth comparison of blended finance flows between these two groups. So we look at the financing levels coming from different investor types across the public, private, and philanthropic sectors. So what we've done in this chart here is we've looked at what the proportion of financing that each group is measuring into blended finance and sort of what does that tell us about where we are in terms of scale and private sector mobilization. So what you'll notice is that both Convergence and the DFI Working Group do have quite similar market estimates. So you can see that the proportional financing from each for each segment of the market is quite similar year on year between the two groups. So 2 items in particular that I think are of note here. So one is that if you look at the segment of the bar chart that's coming from MDBs and DFIs, you'll see that both Convergence and the DFI Working Group find that between 2018 and 2021, an average of over 40% of all financing into blended finance is coming from the MDB and DFI ordinary commercial accounts. And this makes sense if you go back to Nick's comment about how much financing into blended finance is coming from the MDBs and DFIs. It makes sense that such a large financing volume is coming from this constituency. The second statistic of note is Convergence and the DFI Working Group also find that an average of 30% of all financing coming into blended finance on an annual basis between 2018 and 2021 is coming from the private sector. So in the report, we do reflect on the need for more ambitious mobilization targets and how we can get private sector financing contributions to blended finance to be the largest represented source. And we go into some recommendations there. So then beyond this analysis, we also reflect more generally on the state of data transparency and information sharing and how this can be used to build the blended finance market. So we talk a little bit about the need for more granular estimates of mobilization, including leverage ratios, and how this can be used to really inform more efficient deployment of blended finance. So when we talk about leverage ratios, once again, we're talking here about the amount of commercial capital being crowded in for each dollar of concessional capital and the need for more granular estimates. So right now, a lot of the information that we have is on a very aggregate level. So we know in total the amount of financing on a year-on-year basis that might be coming from the private sector compared to other ODA public sources and concessional sources, but really to guide the market and really have a meaningful understanding of where blended finance is working, which instruments are most effective. We need leverage ratios on a deal-by-deal basis and cut across different market segments like regions, instruments, and so forth. We also highlight some very positive developments in the market. So, for example, the release of some of the GEMS reports that have come out recently on loss and recovery rates are a huge milestone. And we also highlight practitioners that are also taking up the mantle and helping build the field by disclosing their term sheets and really enabling replication. Finally, in the report, we also reflect on what we call the post-blended finance story. So we recognize that the ultimate end goal of blended finance is to create an off-ramp to fully commercial markets. So we reflect on the important need for documenting ex-post impact to assess whether blended finance is being successful. And we also highlight in the report blended finance initiatives that have been successful in spurring commercial follow-on investment without the need for concessionality. And sort of all of this goes back to how sharing information and data can help build this story. So if we move to the next slide, I'll go through some of our high-level recommendations here. So first, we talk about where development actors can use their position to incentivize and disclose financial performance information. So given the importance of this information for building the field and communicating real risk return levels to private investors, there's a role for donors and DFIs and other concessional capital providers to build in requirements for sharing financial performance information in an aggregated and anonymized way, understanding that there are a lot of confidentiality constraints. But what are the roles that concessional capital providers can take given their role in the market and the way that they can build in maybe requirements and KPIs into the provision of this money? Our second recommendation goes towards the point about more disaggregated data on the field, particularly on private sector mobilization rates. So we talk about the need to have more disclosure of private sector mobilization data on a direct and indirect basis. So, for example, the MDBs and DFIs make it distinguish between indirect and direct private sector mobilization. So having more granular information on this, as well as leverage ratios, is really important for practitioners and policymakers and understanding what minimum concessionality should be. And also this can help reduce structuring time, help reduce the bespokeness of blended finance models and really help achieve scale. And it also can inform concessional capital providers on how they can design the most efficient toolkit of instruments. A further recommendation that became apparent when doing this comparison exercise is really the need for more timely data on market estimates. So at present, there are large time lags in the disclosure of blended finance activity, which can make it very difficult when benchmarking the effectiveness of blended finance. So when we did this activity, we found that the most recent time period we could use for comparing data was 2021. So data providers should really strive to publish data on the last available calendar year to provide more accurate benchmarking. And then lastly, we talk about the need for market actors and data providers to really collaborate and think more holistically about how they can share and compile data. So of course, there are differing methodologies and also confidentiality constraints, but there is scope for and an opportunity for more strategic data collection and collaborations between organizations to really map out these different segments of the market that are all very important pieces of the blended finance puzzle. So I think with this, we'll move into our first Q&A period, and my colleague Robin will be fielding some of the questions that are coming through. So please put any relevant Q&As within the Q&A box, and we'll be happy to answer them.
Great, thank you so much, Aisha. So we are getting some questions coming in through the Q&A box. Please feel free to throw those questions into the box. We will be both answering them live as well as responding to them through text when appropriate. So we're going to start off with the first question. And Nick, I believe this is a question for you. Where have you seen noticeable uptake in the private sector investment? And this, I suppose, could be sectorally speaking, geographically speaking. So anywhere you've seen those trends moving upwards.
Yeah, thanks so much for that, Robin. It's a good question. I can take it from a sectoral kind of perspective or consideration. So we do see energy and financial services still really leading the way in terms of volume of private sector financing into the blended finance market. But within the last few years, we've actually seen noticeable uptake in private sector financing going to the infrastructure sector. So I believe in 2023, we saw something like a 15% annual increase in private sector financing to infrastructure transactions. And this could be in part a product of the infrastructure as an asset class actually being less tied to the economic cycle. So it's been better positioned to weather some of the challenging or the challenges presented by the macroeconomic environment currently. And if we look to some of the infrastructure subsectors in particular, we are seeing some of the highest mobilization ratios in the blended finance market. So whereas a leverage ratio is the amount of commercially priced, whether it's public, private, or philanthropic dollars raised by every dollar of concessional capital, the mobilization ratio just looks at the amount of commercial financing from private sector investors for every dollar of concessional capital. So if we look at the manufacturing subsector, I believe we're seeing mobilization ratios of over 5. And then I believe the telecommunications sector is a mobilization ratio of over 4. And if we compare that to the overall market, which has an average mobilization ratio of under 2, that really contextualizes the change and the interest among private sector investors for those infrastructure assets. So I can leave it there.
Wonderful, thank you. So the next one, I believe we'll go to Andrew, discussing more of the regulatory side. So Andrew, what are the key specific gaps in the understanding of the blended finance approach among multi-stakeholders and how to approach this gap?
Yeah, no, that's a great question, Robin. So in the report, we really go into some detail in exploring some of the key difficulties that supervisors and regulators face when approaching blended finance. Of course, as I mentioned in the presentation, they're often excluded from the many conversations within the blended finance ecosystem, although they are becoming more aware of the practice of blended finance. And of course, given the complexity of the financial structures in the field, being a supervisor can be difficult. They need to understand what happens to the risk, who's picking it up, and whether that seems to be reasonable or not, with the goal, of course, of ensuring that banks are safe and sound. So in the report, we explore some of the key ways in which supervisors can begin to be more integrated into the practice of blended finance. So as I mentioned during my presentation, this ranges from being consulted early in blended transactions to becoming, to using indicative case studies of what worked and what didn't work, and ultimately coordinating with each other where necessary. Fortunately, we do have a panel discussion coming up later where we'll have a representative of the Toronto Centre, which has really taken the lead in educating supervisors and regulators on the practice of blended finance. So hopefully that conversation will shine further light on this issue.
Thank you very much, Andrew. And now we have one for Aisha. Aisha, as the goal of blended finance, according to the OECD, is to build local markets to the point where the concessionary capital can eventually be removed and market forces can take over, are there any success stories where this has occurred that can be used as a precedent, and particularly interested in an LDC as opposed to more developed markets?
Sure. Thanks, Robin. I think that's a great question. And that's really what's fueled in this report, a reflection on the post-blended finance story, because we recognize that when we're tracking the market, what piece of information is sometimes missing is if we see a change in financing going into a sector, for example, a sector like energy, is that because certain sectors have developed more commercial interest and there's less need for concessional capital, and that's why we might see a drop in sort of financing, blended finance levels going into certain sectors, or does it reflect sort of other investment trends? So what we've done in the report is we have highlighted a few initiatives that we know of where case study examples where blended finance has been introduced to spur investment into various sectors. And so we highlight some of those initiatives and what some of the success stories have been. It is very much highlighting it on a case-by-case basis rather than looking at it from a more holistic market analysis, just because it is difficult to find information in aggregate on sort of what that follow-on blended activity sometimes look like. We are able to identify, for example, series of funds where the first fund may have used blended finance and follow-on funds used less concessional resources or eventually went fully commercial. And similarly, we've looked at some project finance examples as well as bond examples. So I would point our audience towards that section in the report. But I think we are in full agreement that we see blended finance as a interim step towards commercial sustainability rather than a permanent use of capital. Although we recognize in certain contexts, like in LDCs, there's much more need for concessional money. And so that graduation effect is going to look very different. And I think the other point that I'll just make is that we do recognize that there needs to be a lot more emphasis on local capital provision, crowding in local investors and domestic resource mobilization. So we reflected on this in quite a few reports, but I think that continuously we notice that when we look at investment into blended finance from the private sector, it's coming from cross-border flows and global investment trends. So thinking through how we can crowd in more local capital is also a key consideration.
Thanks, Aisha. And I believe we have one more time for one more question. So this will also be over to you. What are the key differences on how different organizations measure blended finance? And just to say that we will continue to answer questions throughout the panelist discussion in the chat. So if your question hasn't been addressed through live answering, then we'll get to it shortly. Thanks.
Robin, I can answer that last question on key differences. So I think we went through high level some of the differences in the ways that different organizations are thinking about blended finance. And we mentioned that, for example, the OECD has a very inclusive definition. So they're looking at, for example, upstream activity. So what is the supply side of fully commercial capital, concessional facilities, whereas Convergence and groups like the DFIs are more reporting on instances in which private capital has been crowded in. So in the report, we do go through a pretty thorough table where we're looking at even things like archetypes and instruments. Some organizations like Convergence consider technical assistance grants and grants as concessional capital and leverage mechanisms, whereas other organizations like the DFIs tend not to. OECD has recently introduced TA as a leveraging mechanism. So I would point the audience towards that report for more thorough analysis. But I think the reflection here is, it's important and helpful to understand what these different segments of the market are. So it's not to say that certain methodologies or definitions are more correct than others. It's more about how can we use this to really guide the market. And for example, if we know what the concessional capital supply looks like and we use leverage ratios, we can better gauge, okay, knowing that this amount of concessional money is in the market, what is a feasible level of private sector mobilization, and are we attracting, how do we attract that level? So I think that's also a key consideration for us.
Great. Thank you very much to Andrew and Nick and Aisha. That concludes the first portion of this presentation. I will be passing it over to Joan to kick off the panelist discussion.
Hello again. Thank you all very much. So we're going to introduce 4 voices on a panel that we've entitled The Role of Regulators in Central Banks. And I'll introduce each of them and ask them to come on camera in sequence. So just to recap here, blended finance, we recognize, operates in a larger context. It is not a separate, isolated field. And we identify as blended finance experts, but we are also anti-silo. And we know darn well that our field connects to the worlds of regulation, banking supervision, and institutional investors who are heavily regulated. So our panel today is going to bring out the voices of others who see and or use blended finance from those perspectives. So I'm delighted to have with us 4 great panelists. Before I go there, I just wanted to point out that we're going to be talking, some of my questions will ask about the frameworks, the regulatory framework for blended finance. I want you to know that's shorthand. We are not suggesting that anything be set up for blended finance as a permanent feature of the investment landscape in emerging markets and developing economy investing. Blended finance is, as we were just saying, a transition. It's a bridge to unsupported, fully risk and returns balanced investing. And we think of it as a bridge not only for foreign direct investment, but also for local investors and the development of local capital markets. So if I get into shorthand about regulation toward blended finance, remember, I'm thinking of blended finance as the entry point for getting more money operating in countries that really need it. So please come join me, Michael Ryland, who is the founding director of the Center for Social Finance Law and secretary of something called the Global Alliance for Impact Lawyers, which we will explain more about in just a moment. Welcome, Michael. We also have Babak Abbassadeh, who is the president and CEO of the Toronto Center that just got mentioned, who will be joining us to talk about their work. Third is Isabel Teams, finance expert at Network for Greening the Financial System, NGFS, if you've heard of that. And we have a lot of acronyms today, so I will go back and describe these better as we get rolling. Fourth, Ben Weissman, who is Executive Director for Capital Mobilization and Public Policy at the Glasgow Financial Alliance for Net Zero, which is also known as GFANZ, G-F-A-N-Z. So, welcome all of you. Thank you for being here. I'm going to start off, and we will go to about 10:05 East Coast time, and then we'll open it up for Q&A. So please do put questions in the Q&A line. So Michael, you are part of the GALE project, which is, again, GALE is the Global Alliance of Impact Lawyers, and you've undertaken a blended finance project, which, as I understand it, is intending to identify and map the legal and regulatory barriers to combining philanthropic, government, and commercial funding, which is essentially blended finance. So let me ask you, and by the way, when we mention people's reports in this panel, we're going to be putting them in the chat line. So everybody feel free to download these reports. They're really there's some great work that's been done by people on this panel and their peers. So Michael, tell me a little bit about some common legal issues. So you represent the legal field in this conversation. Some common legal issues that have to be addressed when structuring blended vehicles. What are the key problems that need solutions? How do these manifest across different regulatory contexts?
Good morning, Joan. Yes, happy to do so. Andrew, in fact, has mentioned some of them, and they're mentioned in the report. So maybe if I just sort of sketch out the legal context. Blended finance raises the same kind of legal issues as other structured financing. But the difference is that traditional legal frameworks and regulatory regimes are sometimes not particularly well suited to blended finance. It's worth distinguishing here between blending public and private finance, like for instance DFIs and commercial banks on a development finance project, from philanthropic and private finance, where you might be looking at, say, a foundation and a pension fund putting something together to say, sustainable forestry or housing, something like that. In the case of the public-private blending, the issues really arise in the risk weighting and the assessment, and then in the risk allocations that are done in the legal documents. In the case of the philanthropic and private financing, it's more focused around the legal divide between for-profits and not-for-profits. So just to sort of play that out in terms of how that manifests, in the public-private blending, that plays out in how structures are designed to cope with risk weightings and assessments, so things like intermediary elements being introduced, credit support, stuff like that. And then also how risk is allocated under the financial contractual terms, particularly the funding and the project contracts, sometimes in debt and equity instruments. And in terms of the design of the structure, the regulatory issues that Andrew was mentioning are some of the key things. So things like the Basel Accords and the standardised approach to risk weighting, the EU securitization regulation and how that can capture risk-tiered blended finance structures, differences between securitization across different jurisdictions, and things like AIFMD2 and the new loan origination rules, and that can have an impact on blended finance capital structures. And these are discussed in the Convergence report or indeed in the GALE report. In terms of the risk allocation side of things, the regulatory weightings and assessments can sometimes lead to sort of a misstatement of the nature of the risk. And that leads to a dynamic where the parties can be the banks and the DFIs, can be looking to minimize and manage a misstated risk by allocating it somewhere else. Sometimes that can be allocated ultimately to a project operator, which is often not the right place for it to go. Lawyers obviously get involved in trying to mitigate that, being innovative, but that leads to complexity and cost and delay. It can also lead to onerous due diligence and monitoring and reporting at a project level. And it can undermine the development or the impact objective of the project. On the philanthropic and private capital side, that's where really, because of the for-profit, not-for-profit distinction, you end up with sort of trying to put a legal square peg in a legal round hole. And that leads to conflicting or restrictive requirements around tax codes, fiduciary duties, types of legal vehicles, governance requirements, all those sorts of things. Again, innovative lawyers will get in there and fix it, but it'll be bespoke. They need solutions, and I endorse the stuff in the Convergence report as ways of looking at that.
Thank you very much. The difference, so the issues are very different when you're dealing with public money and trying to structure and actually recognize where risk has been placed, and getting regulators to see what you've done with your structure, and philanthropic world where the issue is really mandate, and is this philanthropic, and how does a philanthropist interact? And it matters a lot, by the way. Philanthropy is a very small portion of blended finance, but is incredibly flexible capital and incredibly good at experimentation. And so it is really important to improve on where we are now. I'm going to turn next to Babak, who again is CEO of the Toronto Centre, which I think you once described yourselves as plumbers teaching plumbers. That is, you yourselves identify as financial supervisors and regulators, and you provide really good capacity training to others of your peers, mostly in developing nations. So let me ask you about the role that financial supervision plays in the oversight of blended finance. We just heard Michael describe some issues where we haven't quite put the pieces together. Tell us a bit about the key variables supervisors actually need more information on from, say, for example, those who are doing blended finance, so that you can understand these things better and provide effective oversight as regulators. Maybe talk about that interplay of information you need and the job you need to do.
Thank you very much, Joan. It's a pleasure to be here, and congratulations to you and our friends at Convergence for putting out this report. And it's great to share the panel with colleagues, including our friends at the NGFS. We are an implementation partner of the NGFS. Basically, we believe healthy economies with stable financial systems create an environment for investments, for growth, and that's really the raison d'être of Toronto Centre. First is the foundational work that is being done by supervisors and regulators every day. I mean, yourselves, NGFS and others have talked about some weaknesses that act as barriers, weaknesses in fundamental soundness of the economy, the rule of law, governance, and financial stability. And the good governance is really the big elephant in the room. These are not exciting to everybody, but they have to be addressed, and regulators and supervisors are doing it every day. So if you will, supervisors, the plumbers, as you talked about, are already at the table. In fact, they're busy building foundations that are needed for blended finance to deliver on its promise. It is not glamorous work, but it's essential. And we see it happening everywhere where we do our capacity building programs, 90 programs around the world, majority of them in developing countries every year. On top of that foundational role, however, supervisors, we find, are also very interested in this conversation. Let me just give you an example. A couple of weeks ago, as part of the World Bank IMF spring meetings, we held a roundtable on blended finance. We brought in multilateral development banks, more than a dozen central bank governors. Your colleague at Convergence was there as well, and some donor agencies. It was a candid conversation and demonstrated that there's a high degree of curiosity about blended finance in our community. It also reveals some key issues. I think Andrew probably referenced that standardization of deals was a very common point. Not just the idea of proven deals and models, but also strategies to reduce transaction costs for participants. But in order to get standardization, you need information, you need transparency, as well as the kind of analysis that Convergence provides when information is available. So blended finance in support of SDGs and particularly climate-related projects requires rigorous taxonomies and KPIs of impacts. Standards, rules, and evaluations are the oxygen that financial supervisors breathe. And we see a productive role for supervisors engaging here. And one more point about the allusion to the plumbers. Another thing to think about, financial supervisors and regulators, central bankers, they never get the Oscars for a structured deal or something, but they always get blamed when there is some kind of a financial crisis somewhere from any source, right? So what do the practitioners need? And just very briefly, and I'll wrap it up. First, the focus of supervisors and regulators is not so much on the various aspects of the program and the risk, but they need to know how these risks are translated into the balance sheet. Let me stop here and I can come back to other points. Thanks.
Thank you very much. Yeah, it's a sobering view of the world because we are always pushing for more investment, more experimentation. What you're saying is standardization matters, good governance matters, and we hear you on that. I'm going to turn next to Isabella Teams. Isabella, again, is with the Network for Greening the Financial System. And you are a group of central banks and supervisors who, I understand it, on a voluntary basis, exchange experiences and share best practices on how do you mainstream finance, in particular for a transition. And I think we have a, maybe if we could ask the other panelists to go on mute while we're talking, because there's a little bit of feedback, thanks. But Isabella, we need you on with you. Actually, yours. We'll just muscle through. So I wanted to ask you, you have used an interesting report as well, which we will put in our chat line, the NGFS technical document on blended finance. And it talks, among other things, about an ecosystem of solutions to get over the barriers of blended finance, climate mitigation and adaptation faces in getting to scale. Can you talk a little bit about what role central banks and the NGFS play here? What are you referring to in that ecosystem of solutions to get through these barriers?
Yes, thank you, Joan, and also thank you for having me on this panel. So I think the NGFS and the central banking community can really use their convening power to raise awareness about blended finance and also to bring together relevant public and private stakeholders. So, for example, in this document that you just mentioned, Joan. This was published during the COP28, and it's a technical document indeed on scaling up blended finance for climate solutions, particularly in emerging markets and developing economies. And the document describes 7 key barriers that limit scaling up of blended finance, but also addresses or identifies policy recommendations on how these barriers can be overcome. So the barriers that are identified, well, I think they were already mentioned by my fellow panelists. They range from structural issues that are very specific to emerging markets and developing economies, such as, well, their domestic capital markets or climate policies. But they also relate to the more bespoke in nature and complexity of blended finance instruments, the lack of liquidity, standardization, and also scalability. So addressing these barriers really requires partnerships across the public and the private sector, and also includes regional and multilateral development banks and DFIs. And I think the central bank and also the NGF, the central banking community and the NGFS can really support these kind of partnerships by providing a common frame of reference. So lifting the silos. So you just said among participants in the blended finance ecosystem, so that everybody is well aligned on expectations. And I think that is also something that we really try to do in this technical document, really providing this common frame of reference.
Thank you very much. And that goes to the, in fact, it's probably the source of the recommendation in our report about really using supranational bodies to bring out issues and to connect those issues to the parties that actually have the ability to make changes. So your work is, it's very, very important to breaking down those silos. Thank you, Isabella. Ben, I'm going to turn to you next. Again, Ben is the Executive Director for Capital Mobilization and Public Policy at GFANZ, which is the Glasgow Financial Alliance for Net Zero. You're also the Director for Climate Finance Strategy, I believe, at Bloomberg LP, if I'm not mistaken. So here we go, a heavily regulated investor, if you will. I want to ask you to maybe speak on behalf of the investors of the world, if you want to take on that mantle. How can investors formally collaborate with or interact with policymakers and regulators to better facilitate private investment in the economies we're talking about today, the emerging markets and the developing economies? How can you interact with them? How can you share what is important from your point of view? How can supranational forums and investor and government networks be optimized to get more learning out there? What is your take on it from GFAN's point of view?
Thanks, Jen, and thanks for having me, and congrats to you and the Convergence team on this great report. I don't think I can speak on behalf of all financial institutions and investors out there, but maybe just taking a step back on sort of what GFANZ has been focused on when it comes to mobilizing capital to emerging markets and developing economies, and sort of how we've worked over time to bring together public and private stakeholders focused on these issues, and over time, in some cases, helping to formalize them through a number of different channels. So first is just around country platforms, which is not directly focused on blended finance or necessarily on any regulatory issues, but really rather just bringing together the relevant stakeholders, public and private, around how do we address challenges to transition in a particular country and help scale investment in that country, with a key element being there, how do we most efficiently use scarce public finance to mobilize, as many multiples of private finance as possible. So it's really like an important testing ground for a lot of the kinds of things we're talking about here. And GFANZ is the private finance partner to the Vietnam and the Indonesia JETPs, or Just Energy Transition Partnerships. And we're currently working with the Brazilian government and National Development Bank, BNDES, to support development of a country platform in Brazil. And I think through these mechanisms, we're really starting to understand sort of what are the global solutions and global challenges we face, as well as the kinds of challenges at a country level to mobilize private finance and help drive out what are some of the global solutions. And so that leads to the sort of the second area of engagement, which has been around the ways in which multilateral development banks and development finance institutions can better mobilize private finance. So we've been collaborating with a number of other groups to help map out how can MDBs better scale the tools they have for mobilizing private finance, and potentially, introduce new tools or new products to help scale mobilization. And last year, we collaborated with Convergence and a number of other investor networks to put out a call to action on private mobilization for MDBs. But through the World Bank Private Sector Investment Lab, which is co-chaired by GFANZ's co-chair, Mark Carney, also a proud Canadian, we've also been working closely with the World Bank Group directly to help identify specific ways where the World Bank can, either introduce new products, adjust products, scale products that are working really well to better mobilize private finance. And through this channel, we've already made some good progress. I think the recent announcement from the World Bank Group on its guarantee platform to help streamline access to guarantees products and triple guarantee issuance by 2030 is a good example here of sort of what can we do when we work closely between the public and private sectors really effectively. I think when it comes to regulatory engagement, it's much trickier. So regulators and standard setters really aren't responsible for scaling blended finance, as I think, Isabella and Baba can talk really closely to. But they're focused on safety and soundness of domestic financial sectors and institutions. So I think without a big political push, what we need is really better data, and use that data as a basis for engagement on sort of why existing regulations are potentially not reflecting the real underlying risk we're dealing with, and focus on that as like the avenue of engagement. And so I think the State of Blended Finance report is very helpful in this regard, really as a resource for everyone, but especially regulators and standard setters, to understand some of these challenges, as well as more broadly, just understanding trends in blended finance. I think, as Andrew mentioned in his presentation, the GEMS database, I think, can be really helpful here. And so, we definitely need more data in general on blended finance transactions and funds, but I think we also need better data on performance of both public and private sector assets in a lot of emerging markets and a lot of developing economies. And to be really useful when it comes to informing risk assessments, from whether it's from a financial institution perspective or from a regulator's perspective or supervisor's perspective, they really need to be granular at both the country level and the sectoral level to be useful. And I think it's really going to be challenging for the MDBs and the DFIs in the GEMS consortium to provide that level of granularity at maybe what the market and what regulators and supervisors need. But perhaps what we could think about is, like, is there an interim step to, sort of sharing this more granular data specifically with regulators and supervisors to help inform some of this discussion? And so I think when it comes to how can we engage, I think, utilizing channels like, the Toronto Centre, like NGFS, that really already are bringing together the relevant stakeholders, I think is critical. But it's like, how do we make sure that they have the right data that's relevant for their specific mandates? And we want to be helpful there to the extent we can. And we're grateful to support Convergence in this work as well.
Thank you very much. Great insights coming from the investment community there. And I do realize you don't represent everybody, but it is a very real world point of view. I want to go back and I'll start asking Isabel, but I would be happy if any of you want to jump in. We could organize this panel as a confrontation between the regulators of the world and the private sector gung-ho investors of the world. But that's actually not the problem here, right? It's translating information about risk to regulators. It's regulators understanding the structures and the motivations of the parties. So Isabel, I'll start with you, but Babak or Michael, to jump in, please do. The question is essentially, financial supervisors and regulators are becoming more aware of, for example, things on which we have common ground, the increasing risk of climate change to stability, the increasing need for investment in climate change or mitigation adaptation. So you've got a place where there's common ground. Maybe you can talk about some of the work that NGFS wants to do in better, driving home that point that we have a risk from climate change. We have, things that we may be able to do to invest in a different future. And then you have the regulatory issue. As opposed to pitting each other against each other, let's talk about this common ground for a moment. And Isabel, I'll start with you, but I don't know, Babak or Michael or Ben, perhaps you want to follow on.
Sure. Thank you, Joan, for this question. So no, I think you're very right. There is a very important common ground, and which is combating climate change, which will be a very important source of risk in the future, both from a transitional risk side as a also physical risk side. So I think decreasing carbon emissions, both now and in the future, can be seen almost as a public good. So from that side, it is also part of central banks and supervisors' mandates to take these kind of risks into account. So that's what the NGFS do. We look at common grounds. All central banks' mandates are different. Let me start there. So mandates of central banks can be very, very diverse across the world. But what the NGFS does is trying to look for common ground between all these different central banks and try to make progress and steps forward. So I think our work on blended finance is the first time that we also really looked in how we can scale up transition finance in emerging markets. So not only looking from a risk perspective, but also from another perspective. I see Babak is trying to come in, so I will stop here right now.
Oh, no, sorry, I didn't mean to in any way slow you down. Please finish your point.
No, I was finished.
Okay.
So
no, I was actually gonna take do a sec on what you're saying. I think it's critically important. Climate is a very interesting topic here, Joan, because if you look at it, Toronto Centre was involved in trying to put the climate risk of financial institutions on the agenda of supervisors and regulators ever since 2016, right after the Addis Ababa action item for financing. But and it was really, in my view, was a grassroots effort. Like, it took a long time before standard setters started working on it. NGFS was created. Mark Carney played a role, but really it was a grassroots effort. And to that end, we are already beginning to develop a course on blended finance, which we are seeking collaboration from your team, and they're helping out on that, to bring that community of supervisors and regulators and central bankers, buoyed by the event we had in Washington, to familiarize them with these issues and the risks that are looking at. And if you look at, there's some movements at the global level already right now. For example, the Basel Committee revised its core principles, and climate now is recognized as a major risk and is going to be incorporated in financial sector assessment programs. Having said that, the Basel Committee also doubled down on many other issues that may or may not be welcome to this community, which is operational resilience. Don't take your eye off risk. But there's no saying that these things may not be incorporated in the future. And I'll refer people to the publication that we did about a couple of years ago on blended finance implications for financial supervisors. It actually went through a lot of the steps one by one, and Convergence also had a bit of their fingerprint in it as well. So I think it's not all doom and gloom, and there's an opportunity for regulators and supervisors. But I go back to the fundamental essence here. They need to understand the risk. If you're a sophisticated investor, if you're an accredited investor, if you're a big institutional fund, great. You know what kind of risks you're taking. But if you're transferring these kind of issues to the commercial side of the banking, that commercial bank still has to be able to understand what the risks are. Today, blended finance, sadly, is not a very big envelope, as your colleagues presented before in terms of what's happening. But using your own words, if it's really a bridge to an eventual state when the blended finance is no longer a topic, then at that point, these investments will grow in scale. And once they start growing in scale, these risks are material at that point, right? So that's why one should never take their eyes off that lens of risk. And Ben, I think your point was very correct. At the end of the day, supervisors, central bankers are not there to make these deals. They just want to make sure that someone doesn't come and say, this time is different, because we all know what happens when that happens, right? So, we're there, we're trying to help out here, and we're hoping to be able to build that knowledge again, ground up. And frankly, I welcome the report that NGFS put out. It's almost like Air Force support for us, right? As we are working with supervisors and regulators, there's this supranational body, as you said, comes forward and has a very well-reasoned document, which I encourage everyone to read. Thank you.
Thanks. Michael, did you want to jump in?
Just one very quick thought, which is when you're taking a sort of blended finance lens at particular climate type issues, I think one of the things we're going to need to do more work in the future is understanding non-financial capital and value, and understanding how nature-based accounting and things like that are going to fit into structures. And just from a legal point of view, I know that that's not an area where legal framework is particularly good at the moment. So that's a sort of on the checklist for things to do.
That's actually an important topic. And one of the questions, I was trying to scan the questions quickly here. One of the questions is actually asking about, LDCs and, nature-based solutions and in LDCs. And it makes me think about how there are haves and have-nots among the countries that we're all trying to support in terms of ability to create taxonomies, strength of regulatory, their capacity, the governance, Michael, that you mentioned early on. So would any of you like to comment on that, on what all of these issues look like in really, really low-income places where capacity is quite limited on the regulatory side? What is important to do in that context from a regulator's point of view, from an institutional investor's point of view, or perhaps this is not the world for institutional investors, it's more for local investors. So maybe I'll ask an investor point of view first, and then maybe Michael, I can go back to you on the second.
Thanks, Joan. I mean, I think one thing to keep in mind here is really to your second point, which is just that, ultimately blended finance and more broadly, like how we think about where private finance and particularly international private finance can be mobilized really needs to be driven by the underlying business and investment case of what we're talking about. And so if the degree of whether it's concessional or other public support needed to make an investment commercially viable for mainstream international investors is too significant, and actually, sort of outweighs the cost of just that being provided via ODA or sort of other channels of public finance, then maybe we don't need to think about, is there a way to address the full set of barriers, regulatory, commercial, et cetera, to make those investments viable? And I think obviously there are plenty of LDCs where there are opportunities for mobilizing international investment with the right degree of structure that that takes into account, the underlying risks of the country as well as the regulatory challenges associated with lending or investing there. But I think we really need to. We have a very limited amount of concessional finance globally, and we have a very limited amount of broader public finance globally, and we need to be really conscious of where we're using that. And I think the same could be said as well in sort of middle income countries where perhaps certain kinds of sectors don't require a significant amount of public investment, public international investment rather, and could be better financed with international or local private capital. And so I think finding that balance globally is really important. And it's not easy, right? Like, especially when you think about MDBs and DFIs who have long investment track records in certain economies. How do we make sure that the right mix of public and private investment is being used? And country platforms can be helpful there, but they're not going to be helpful everywhere. So
fair enough. Yeah, and some LDCs can successfully draw in international capital. I'm thinking of Rwanda, where they had a green bond issuance. I don't mean to group everybody blithely into one category, but yes, I hear what you're saying. Essentially, the game may not be to get the biggest, most regulated investors into every market, but to look at the more appropriate investor set for a given economy at a given time, and then maybe regulators need to be focused on that objective more as well. And Michael, do you have a sense of the same issue in LDCs? What, from a lawyer's point of view, what are the differences when you're working in an environment where some of the institutions perhaps are a bit weaker?
Sometimes it's reflecting the way things are structured. I guess I agree very much with what you and Ben were just saying. The only thing I guess to add would be there is a sort of a feature of mandatory self-regulation. So we see the sophisticated regulations that come, particularly through the EU. Countries which don't have their own equivalent regulatory structures are often takers of that regulation. They have to be takers of that regulation because they're relying on finance economies or relying on other sorts of economic arrangements. And sometimes, therefore, that means you need to look pretty carefully about whether or not that kind of regulation is having the right kind of impact in those countries.
Thank you. Yeah, it differs, doesn't it? So I would encourage people to put their questions in the Q&A line. I'm happy to share the role of asking questions with all of you. Babak, I see that you wanted to say something. So
yeah, just very quickly, Joan, thanks. A fascinating conversation. I think one way to look at it is you're talking about LDCs, places with sort of weak regulation. So let's deal with it head on. Let's just build the capacity of these financial sector regulators and supervisors everywhere. Right? We're in Sierra Leone. We're in so many different places. And it's very sad because the global community, when they think about building capacity of supervisors and regulators, they only think about it post the financial crisis. I mean, why not do this thing in a proactive way? And, when we teach a course, we teach a program called risk-based supervision. So we bring all kinds of various things in it. And dealing with a blended finance world in the context of a risk-based supervision is much smarter than expecting a regulator or supervisor go into a bank and recalculate their balance sheets, right? So that's what I'm trying to, let's just flip the script to be able to do that capacity building in a very proactive way early on. Thank you.
thank you very much. Okay, let me see where our questions are. I think I dealt with the LDC one, and I think we're good here. I had a question that I wanted to ask actually, but I'm off my subject. I know it's about taxonomy as well. When I look at the JETPs, one of you mentioned the Just Energy Transition partnerships that are happening, obviously in places like South Africa, Vietnam, Philippines, Indonesia, and so forth. It seems to me that there's a taxonomy issue too, right? And regulators and others may look at any kind of financial package to say wind down a coal-fired power plant early as a brown investment, and therefore discourage financial institutions from being part of the restructuring package. How important are things, how important is interoperability of standards across places? I mean, if, say, Singapore writes a rule that says you get a transition credit for doing that kind of finance, but in France, they say that's a brown asset, where are we? So what is, if any of you would like to comment on that whole interoperability or harmonization of standards and regulations across across nations, maybe it would be interesting for our audience to hear where we are on that subject. Open forum. Anybody who'd like to comment? Ben, you look like you want to.
Thanks, Jen. This is a huge issue, and I think it's both the interoperability and harmonization globally side of things, but I think it's as equally just the focus on transition finance in addition to the pure green. And so this is something that GFANZ is really focused on. How do we ensure that we're moving towards a consistent global approach to transition finance in the context of taxonomies and in the context of sort of policy structures that either incentivize or disincentivize certain types of financing as it relates to climate. And so GFANZ, about 2 years ago, we put out sort of our what we would call our 4 financing strategies, our definition of transition finance, which looks at sort of the full spectrum. So everything from climate solutions and enablers to companies that are already aligned with a net zero pathway, to countries or entities that are in the process of aligning according to their own transition plans, and then to the managed phase out of high emitting assets. And this in particular is relevant for coal assets. And when you look at some of those JETP countries where coal is potentially the main driver of emissions today, that's really essential as well. And right now, I think we have a number of economies that have developed taxonomies that are in place that are really focused on the first 2 of those. We have some taxonomies under development. You mentioned Singapore, you mentioned ASEAN. I think in those economies, we're starting to see this sort of full spectrum. But to the extent we can make progress towards all countries recognizing that spectrum and not, incentivizing or disincentivizing based on past emissions of a particular asset, but instead focusing on the future emissions trajectory associated with implementing a transition plan. And so we welcome sort of the underlying work that the standard setters and NDFS, for example, have been doing on transition planning, really building on the work of the private sector to develop a consistent global approach to transition plans. And that's going to be like a critical underpin. And I think that's especially the case in emerging markets and developing economies, where when the government has a net zero target or an NDC that is aligned with a date past 2050, where many net zero committed financial institutions are focused, you really need to have that credibility of an underlying plan, as well as just the sort of air cover from regulators, from MDBs and others, that certain types of financing are considered transition finance.
Isabella, did you want to jump in as well?
No, yes, I think I can just, I fully agree with what Ben just said. I think transition planning is very important and is really the new, hot topic, so to say. It's difficult, though, the forward-looking metrics, the data that we need for that. There's still a lot of debate how to, what is a credible transition plan and how can you really validate if companies achieve their goals. How do you monitor this? But it's an interesting field and there's a lot of development going on. So I echo what Ben just said. Thank you.
And it's funny because one of the questions coming in are increasingly severe climate impacts affecting the risk profiles of projects in developing countries? And I think I speak for all of us in saying we all see it in our own way. We each of us from our own vantage point are seeing weather events making things uninsurable, cost of capital skyrocketing, availability of goods threatening, supply chains and people in emerging markets access to markets on a reliable basis. So I think the answer to that one is a pretty solid, yeah, we definitely see it. There was a question of whether anybody has any up stories, successes, quick wins or hard-fought wins from your area of work. So I might put you all on the spot and ask you to go around and either state a report that you've put out that you think synthesizes a community's point of view, or a specific country where you've seen something amazing happen, or a type of regulation, or, you know, it could come in any form. And I realize, Babak, that you don't get Oscars for, you know, the regulatory environment that didn't crash, but maybe in your quiet world as well, you've got some wins. So I might close us out that way by going around the room and asking each of you to think about what has gone right or has seen progress recently. And I'll go in the order that you appear on my screen. So Michael, Babak, Isabel, and Ben.
Okay. Maybe if I could just refer to the Gale report that's been put in the chat. We collected a series of case studies around the world on a range of different blended financing. And basically, they show that blended financing work. The countries are responding to legal issues. They're responding in a fairly patchy way. But there are some that are doing a lot of thoughtful work. There's more done on the philanthropic private blend than there is on the public-private. And there are a bunch of different reasons, I think, for doing that. But I think so long as that sort of effort is put into it, yes, there'll be legal solutions.
Thank you. I think that is a win. And I do encourage people to read that report. I thought it was very well done, and I'm not a lawyer. Babak.
Yeah, there are some interesting stories. I don't want to make any countries jealous, so I'm going to keep them anonymous. But Kenya and Rwanda, for example, there are a couple of good examples that come on our radar screen, water sanitation projects and others. But another thing that I want to sort of build on what Ben and Isabella talked about, standardization is very important. And you might be shocked to hear this from me, but I don't think we need to wait for a perfect standard, right? Because we need to implement, we need to figure out ways to innovate. Looking at our world, fintech was a big headache for financial supervisors and regulators for the longest time. And essentially what this community did, they did a lot of sandboxes. So why not do some sandboxes and experiment with things? And once you see something succeed, try to upscale it through dialogue with other supervisors, regulators around the world. Maybe that's how a good standard can come from, rather than a bunch of experts sitting in some European big city or small city, influential city, and come up with standards. Let's try to figure out a bottom-up approach to these. So I'm very much supportive of that. And if there are any additional success stories, let us know, because we want to include them in our workshops that we're developing for supervisors and regulators on blended finance. So Joan, keep us in mind for that. Thank you.
Isabel, a happy story, a positive story, if you have one to offer us.
That's a happy story. Yes, yeah, I do have a happy story. So I think, first of all, awareness is very, very much increasing for blended finance in the entire blended finance ecosystem. So I think that's a positive thing. Also, the information is increasing. The GEM database was already mentioned. So transaction data is becoming hopefully more publicly available, which will really help to increase transparency and also to mitigate the perceived risk that was already mentioned before. So those are two, I think, very positive developments. And then Babak, we have 8 case studies, demonstrative case studies in the NGFS reports that really demonstrates, specific. It's a very broad geographic spread. In different cases in which blended finance was implemented successfully. Also, so there's diversification in terms of countries, but also in terms of which kind of blended finance instrument was used. So concessional capital or more guarantees. So maybe you can get some inspiration from these cases as well.
Yeah, because we haven't mentioned guarantees in this conversation. They are an incredibly important part of the blended finance world and in motivating private capital. So I do encourage people to look at that issue as well. And Ben.
So on that note, I'll refer back to the World Bank Guarantee Platform, which was announced 2 months ago. So I think in the context of the World Bank Lab, the private financial institutions who are part of this really made clear that guarantees are, as you said, Joan, like really essential at mobilizing private finance, are really effective and efficient. The challenge is just accessing them in some cases. It can be difficult and be time consuming, and it's really unclear ultimately what the terms will be in those tools. And so understanding those better, being able to access them in a more simplified manner across MDBs, in this case across the World Bank, groups, different institutions will be really useful. And so, the bank announced that they're going to develop this, that they are developing this platform. It'll be rolled out in July, and it'll support tripling of guarantee issuance by 2030, which I think is a really good starting point, and hopefully something on which other MDBs can build, and the World Bank Group can especially start to innovate and figure out, are there ways to blend different guarantee products as well as different balance sheets across the institutions to address specific challenges that financial institutions are facing. So.
And Joan, this is also a shout out to the joint funders of Convergence and Toronto Center, Canada and Sweden. They're like taking guarantees as well. So I had to slip that in, right?
That's true. Waving the Canadian and the Swedish flag for a moment there. Yeah, and also I think there is some work to be done on the regulator side to understanding what those guarantees actually provide and what they do for risk that regulators are trying to manage. So there's some dots to be connected there as well. I'm afraid we have hit time. We've had a wonderful tour of part of the ecosystem around which blended finance happens. We've heard about risks, real and perceived in some ways, and how regulators do need to deal with those. Those are also issues that get dealt with substantially by the lawyers in the transactions who are working on them and trying to make them bankable. We heard a lot about standardization, and that is an important theme in blended finance. It's also an important theme if you're trying to ask regulators and banking supervisors to understand something. It's better if you don't come at them with 50 different versions of something. I hear that message. Information sharing is a big topic that we were just hearing about. So the convening power of networks like GFANZ and I'm getting my acronyms messed up. The NGFS, your convening power of institutions or supranational bodies like you, I think is really important to bringing coherent, clear messages along. We've heard about the need for really shoring up the capacity of host governments to deal with all of us, trying to get things done while being responsible to their own citizens and their own economies. So if we could all collectively applaud, we would be, but in the absence of that ability, I just want to thank our panelists, Michael, Babak, Isabel, and Ben very much for providing the perspectives each of you have provided. I encourage everyone to go back into the chat line and pick up all these reports and, of course, to download our State of Blended Finance report, which if you don't see the link here, it's at www.convergence.finance. And thank you, everybody. I think we will end there. We really appreciate everybody's support and efforts in putting a report out. We would love feedback. Come at us in any way that makes sense for you, and we'd be glad to field your feedback. Thank you very much, and have a great day or evening.